You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. The Options Insider Radio Network is sponsored by Fidelity Investments. Fidelity's Option Trade Builder tool can help you confidently build an options trade in 3 simple steps. Just choose a strategy, select a contract, and then review the benefits and risks of the trade. Learn more about Option Trade Builder at fidelity.com/options. Options trading entails significant risk and is not appropriate for all investors. Certain complex option strategies carry additional risk. Before trading options, contact Fidelity Investments by calling 800-544-5115 to receive a copy of the characteristics and risks of standardized options. Fidelity Brokerage Services, LLC, member NYSE SIPC. Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live every Friday at 1:30 p.m. Central, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by QuikStrike, options pricing and analysis software. QuikStrike offers powerful and flexible options analysis and pricing tools via an easy-to-use web-based interface. View prices on outright options or spreads with comprehensive page-level analysis controls. Build trades, manage risk, or explore historical volatility. QuikStrike has you covered, with market data reports ranging from open interest to the term structure of volatility. QuikStrike is the perfect addition to your trading toolkit. Learn more about QuikStrike at bantix.com. That's BANTIX.com. And don't forget to follow us on Twitter at QuikStrike1. That's QuikStrike1. This Week in Futures Options is also brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This Week in Futures Options is also brought to you by FTSE Russell, a leading global provider of benchmarks, analytics, and data solutions. Investors in the U.S. and around the world are using FTSE Russell indexes to benchmark their investment performance and create investment funds, ETFs, structured products, and index-based derivatives. Many Options Insider Radio Network listeners will be familiar with the Russell 2000 Index, Russell 2000 Futures and options are currently trading on the Chicago Board Options Exchange and CME Group. For more information, please visit ftserussell.com, cboe.com, and cmegroup.com. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody. That funky tune means it's time to get funky with a little futures options activity, some analysis, some volatility, some skew. Mix it all together, some questions, all sorts of fun stuff. You got the tasty, delicious cup of joe that is QuikVol. My name is Mark Longo, and you know what we do here. We talk about all sorts of fun stuff on the network. By the way, if you're listening, if you enjoyed that Advisor's Option, you want to hear the rest of it, subscribe to the network. Easiest place to get there. You can go subscribe to Advisor's Option by itself as well, but the network gets you everything, including QuikVol. So why wouldn't you want to do that? You can get that at all your major platforms, or just go to our website. Easiest place to find all that good stuff. And of course, you can always join us live every Thursday, 1:30 p.m. Central, here on the old Mixlers, or grab our mobile app. It has all the shows and everything going back to 11 plus years now. So it'll keep you covered. However, you listen live after the fact, make sure you hit us up. Questions, comments, insights. We got a lot of good questions coming in this week here for QuikVol. So we'll see if we can get to a bunch of them on the show today. And joining me to help me do just that and help me answer some of your Qs and talk about what's lighting it up in the old futures options market this week, my compatriot, my old friend, the man who helped me kick off this whole QuikVol fun experiment here, Mr. Nick Howard, the founder of Bantix Technologies and creator of a little platform we like to use around here called QuikStrike. Mr. Nick, welcome back to the show. Happy Thursday, sir.
Oh, is it Thursday already? I thought it was Friday. I was still getting used to the Thursday show.
It does feel like Friday, doesn't it?
Yeah, well, it always does. I just, you know what, I haven't been very productive. Well, I've been semi-productive this morning. I've been watching the Kavanaugh Ford
to the TV
hearings thing.
I don't know if that's productive or that just means it's going to get you in outrage mode, you know, those kind of things.
It's pretty outrageous for sure, but you know, I feel compelled to watch it given the current situation. But other than that, all good. Got some. I'm excited for today's show as well. We do a little change, hopefully, like you said, and figure out what we're gonna
mix it up a little bit. Be kind of fun. Let's kick it off. Actually, we're going to kick it off in your old stomping grounds, Mr. Nick, in the rates, because I don't know if you noticed, if you could peel your eyes away from the drama in D.C., Mr. Nick, but there was a little thing going on with the Fed this week too, and our friends over there and the Fed pretty much surprising no one. I didn't get a chance to check the latest. Nick, you guys do that, so maybe you would know. How high did the Fed Watch tool get for the probability of the quarter point? It was over 90%, right?
Oh yeah, for sure. It was. Before the meeting, I think it was 99. So the meeting is still, yeah.
So pinning the needle pretty much, yeah.
Yeah, pinning the needle. And it's and the percentages are starting to shift, or at least November's got a slight chance of a hike, but December is basically at an 85% chance of a hike already. So, you know, I think I don't think anything's going to happen in November. I think the notes and their path has been pretty consistent, and people have been playing into it. But what's interesting is if you start to go out, the probabilities really start to increase a great deal. You know, even going out to March, there's starting to be a slight chance of us being the target rate being between 275 and 300. So, or you know, 2.75% and 3%. So. Yeah, I think that they're going to be aggressive with it, but you know, it's been a yawner a little bit because they've been pretty much following the recipe that they have put out there. But when you start to move out into the middle of next year, I think would really throw the market into a tizzy is if they did more than 25, because everybody's been expecting 25, and the futures are generally priced with that in mind, maybe with a little bit of a tilt towards the next one. But you know, in the old days when we were down there. You know, there were 75-point moves, 50-point moves, quarter-point moves. I mean, there were some big ones.
The old days. Since you brought it up, sir, I think we'll actually, before we get into the activity, by the way, you guys, as always, can follow along with the reports. Just go to bantix.com, BANTIX.com, or QuikStrike.net. Log in. If you're already a user, if you're doing that, we're going to kick things off in rates. So choose rates from the drop down. Choose euro dollars. I made the mistake of selecting all in the euro dollars, Nick. So many months strikes out here. I got to scroll for days to get all of it, but you guys can do that too, of course. If you haven't checked it out already, cmegroup.com/TWIFO. You can check it out there as well. If you want to find the reports, Quick Reports is for what we actually talk about. The report we've built for this show is go to the Quick Reports tab in the top there, and then click on the TWIFO report, This Week in Futures Options. You'll see exactly what we got right here. It breaks it all down for you. It's actually really cool. It shows you the futures move. It shows you the vol change, the skew. We'll get to all the skew fun stuff in a little bit, as well as the most active months and strikes out there. But Nick, I'm going to cheat a little bit. Since you talked about the old days, I'm going to go really quickly to a question. We have got a lot of questions coming up, so we'll get to more of them later, listeners. But I'm going to cheat and bump one up here from Nittles. I like that handle. Man, I just like the handle. Nittles. Nittles wants to know, Mabe, I think it means maybe. Mabe Nick can talk about what the Euro pit was like back in the go-go 90s. When rates were rocking under Greenspan. So yeah, those were hot and heavy days, Mr. Nick. I know I wasn't a Euro guy. I never was a CME guy. I was over there in the SPX pit on the SIBO. But it was crazy, obviously, even for us. Those were the days, when that you remember that, Nick, of course, like the briefcase indicator, everyone would measure the thickness of Greenspan's briefcase. Uh-oh, it's a thick one. We're in for something crazy. You remember those days?
Yeah, I mean, it was it was a lot different. I think it's still pretty active down there, but it's a lot more of a one-way street than it used to be. There was really great flow back in the early 90s. I got down there in 91. I think I started trading in 92 and a half, or at the end of 92, and then was trading through 98 when I was down there. But it was back then at 10:30 there used to be the Fed announcement. There'd be a Fed announcement every, I think it was 10:30. So the market go up whether they were putting money into the system or taking money out. So you really couldn't, somebody always had to be in there and there'd be match sales, and that means it'd be putting money in and then or taking money out. And then it'd be when the Fed was buying. So you had the chance for a lot of things happening, and the numbers seemed to have a lot more kick than they used to. So obviously there was the unemployment number on Friday, but the CPI and the PPI, those were market movers. Even the national purchasing managers things, and NAPOM we used to call it, National Association of Purchasing Managers. All that stuff had the ability to move the market, and some of the. And I used Dickens' quote all the time to describe the pit back then. It was the best of times and it was the worst of times, because when it was going great, it was really a lot of fun. And when it was bad and you were just getting run over, it was just not great. I guess that you could say that for trading in general. But some of probably the most fun was obviously unemployment days, because it would be good. And I could remember, and it was jam-packed then too. So you are standing. It was the stereotypical thing you see where you were piled on top of each other, and typically you had your sheets in one hand, you were all standing side by, butt to belly, and that's how you were, and you were making your markets, and you had your little, each of us was under like one of the top brokers. So if you were 3 or 4 guys in the group, everybody was by like the big broker in that section of the pit. But the one thing I remember just so vividly was on unemployments, basically sweating through T-shirt, shirt, leather belt, and trading jacket. That's how jam-packed and crazy it was. And the bell would ring, and before you know it, the bell would ring for close. It was insane. So it was pretty good, and there was great volume. It was good two-way flow. You could scalp in a given day. There was difference of opinion between the locals a lot of times if you want to flip positions, so you can go outside the pit and trade that way as well. So it was a lot of fun. Although I would tell anybody at this point to stay away from it. There's no point in going down there anymore because it's not quite the same.
We have another question maybe about that. We'll get to a little bit later about becoming a member of the exchange. But you're right. I remember back in those days, and I would come from the SPX pit, which is not a small pit. It was smaller then than it became, obviously, but still it was not a small thing. And I would walk over to CME sometimes. We'd obviously have operations on both exchanges to arb back and forth. And if you're trading SPX, you have to have the S&P options and the SPOOs and everything else going. So you had to have headsets going, and you'd go back and forth. I'd walk over to CME. I look at the Eurodollars. I just shake my head like, this is bad. madness, even to me. It was so big, and it was all the different sections and like the colors and all this crazy nonsense. And I was like, this is crazy town, even for me. So yeah, those must have been fun days back in.
Yeah, it was good. I mean, you had the futures pit you saw the futures pit was massive, right? And you traded the different parts of the curve, the whites, the whites, the reds, and it was mostly the whites and the reds, and then the spreads back then. They had the full part of the curve, but we in the options pit, the most we ever hedged against were the reds. Occasionally, you might end up a little further out. If you got stuck on something, you'd spread, but you really typically weren't doing that. As I was in there longer, we went from having basically, we had paper sheets. We went from basically having like, the 4 quarterlies and then their serials. So you might have, in the reds, you might have 12 sheets to the point where we started having, there were 24 sheets, 28 sheets you had to make markets on. You make markets on all of them. So it was definitely, I remember the first day I walked in there and I had just left a good gig, as being a programmer, and I walked in there and I'm going, what did I do to when I was clicking, I go, I made a bad mistake, and I got over it eventually once you kind of got used to it. But yeah, I wouldn't trade it for the world. How about that?
It's a different environment than programming. So you made the opposite switch. Most people have gone from trading to upstairs now. You went from upstairs to trading, so that's a little bit, and programming for trading instead of the other way around. That's kind of the opposite transition everyone made. Speaking of transitions, let's get into it, Mr. Nick. Since we're talking about it, let's talk about Eurodollars really quick. I'll let you take the lead on this one because this is your baby, and like I said, I mistakenly opened up all the months and strikes here, so I am awash in Eurodollar data. But yeah, fascinating stuff. Interesting. The numbers you talk about too. Sometimes I think it kind of just makes people's eyes roll back in their head, Nick, because we're talking about numbers like these D's contracts here in your beloved pinks out here. They're doing 297,000 contracts in this 96 3/4 put. I mean, these are numbers just in this one month and strike that eclipse most other products we talk about out here. So the numbers out here are kind of just amazing. So maybe I'll let you run through anything catching your eye out here in your beloved Eurodollars this week, sir.
Yeah, I mean, that's kind of, as much as I know the market, it's kind of not it's a weird one to talk about because when it really compresses as you get towards, especially, well, here's the first thing. There's 42 million and change in open interest. So just that alone is insane, right? And an increase
just mind-numbing these numbers.
Just mind-boggling, right? I think from what I've seen and from what I've been hearing lately, some of the downside bets or some of the bets that have been made that the Fed is going to stop tightening have started to taper a little bit. So maybe we start seeing a little bit more of a spread of strikes. But there were, as we mentioned in weeks prior, there were some big trades going on where there was some expectation that the Fed was going to stop at a certain point. So there were some 1x6s and stuff like that on. But, the euro, the markets, it's we say the S&P doesn't change that much in terms of how the skew is. The euros doesn't all that much, but then it does. Like right now, and as we talked about, the puts are offered in comparison to the calls. And here's the one thing I wanted to. We talk about a normal vol or a basis point volatility and everything in QuikStrike. Back when we were trading on the floor, we did stuff in black or American vol, however you want to look. We call it the black 76 or Black Scholes vol. And you had to be careful back then because I think we mentioned it at some point where you couldn't look a volatility of like 40 on a 97 strike was much different than a 40 volatility on a 99 strike. Okay, so but and my point of saying that is that you used to have to be careful to determine what strikes were cheap in comparison to each other. Right now, we have the basis point volatility in QuikStrike, and most people at this point are even using that on their sheets in the trade. And in fact, Bloomberg for a long time lagged on that, and they finally did it a few years ago where they went to the basis point volatility. But now what you can see without having to do any calculation, since it's a yield volatility or a basis point volatility, you can tell, you can look, and when you see a number 60 at one strike, it's the same as a number 60 at another strike. So it's become normalized. And what's very interesting now is, the puts are very offered in comparison to the calls, and that's the thing. You really, of all the places to pay attention to skew, this is a good place to pay attention to it because there will be a time where that flip will happen, and it'll flip hard. So it's probably something we should watch. We can start, coming this on a regular basis. And while we're in this mode of tightening, right? So people are starting to, beat up some strikes in the downside because their expectation that we're moving towards that. And what's important for people to know is if you move slowly towards a strike, that volatility typically gets hammered, or the expectation is going to get hammered. And that's, for another show, is one of the reasons I'm sitting upstairs, is because I learned the hard way that volatility moving towards a long strike will be very bad for your deltas as you go down and just things in general. So before I have to run off and get Kleenex and break into sobs, I'll stop telling that story. But that's really what I'm noticing here, is just how offered the puts are. And it's obviously the environment, but it's definitely something to pay attention to, because there are going to be some places where you can do some spreads that will benefit you from a trade standpoint, where you can start to sell put spreads and pick up some cheap stuff, or to start doing some 1x2s and take the chance that some tighter 1x2s nearer that the money, and take some chances that we get a little bit of a scare and the futures run up a little bit, and you can make some dough that way.
Before we get too sad there, Nick, reminiscing of old days, we'll move on to maybe a happier product. I know one you like to, and I know a lot of our listeners like to talk about as well, and it's on the minds of a lot of people these days as it continues its upward trajectory. This is, of course, Texas tea, the black tar, a.k.a. Crude. An interesting week out here. We've got a lot of things going on. We saw a little bit of a rally yesterday, about 1% in WTI. A lot of that over concerns over Iran. Net on the week, we're up to about one handle, so about 2% now in the week, right around the 72 handle coming into the show here in the front future there in WTI. Again, a lot of that set to a little bit of tightening ahead of the sanctions on Iran, which are set to take place on November 4th. So we got a little bit of time ahead of us. Iran used to be a pretty sizable player, about 3 million barrels a day. That works out to about 3% of global consumption. As these restrictions are coming in here, we're seeing exports dropping to about 2 million barrels a day as it's heating up over there in Iran. Of course, the domestic story is another one as we continue to just crank out as much as we can here. U.S. crude production hitting a record 11.1 million barrels per day. That's through the week ending last week there. That's according to our old friends at the EIA. But still, it's a question whether all that rising output here. Remember, we have a supply chain limitation. We can't export that much, so it becomes an issue where we can make all we want, but if we can't ship it or get it out there in the pipelines, that becomes an issue. We can't really offset the losses from Iran. Hence, the continued slow upward rise here out in crude land. Vol kind of a mixed bag. The nearer portions of the curve coming off a little bit. The longer term portions picking up a little bit of juice, but at the end of the day, not a huge move for vol in either direction. In terms of what was lighting it up out here this week, oh, by the way, OI up nearly 6%, so pretty robust week out there in terms of what was lighting it up out here this month in crude. It was the Nove 66 puts, which is an interesting strike given the fact that we're at around the 72 level out here right now. It was actually a pretty close dance between those and the D65 puts, both doing almost exactly the same amount of volume. 25,808 to be precise in the Nove 66 puts. Pretty much all of that coming on Monday and Tuesday, 11,000 and 12,000 each of those days. The rest of the week kind of light. A lot closing, about 12,000 closing, so maybe a bit of a roll out here to Dees. That could certainly be possible. Let's go also 25,000 of the 69 puts going up. Worth noting 11,000 going up on Tuesday, but about 12,000 of the 66 puts traded same day as well. So maybe a little bit of a put vertical as well. 66, 69 put vertical maybe going up there. Also worth noting, number two, though, was actually out here in the Dees. The D65 puts 25,600 of those. Lion's share going up today. 17,000 and change of these D's puts lighting it up. So clearly not a roll from last week when it comes on to those. So a lot of interesting action. Let's see if we could find some calls. Also 62 puts out here in Jan 2019 doing 20,000. So a lot of little bit, not quite long term, but a little bit beyond front month downside puts are lighting it up out here and very near-term downside too, except for these 62 puts. Obviously, that's a little bit farther up or a little bit farther down the chain. A lot of put activity out here. It's not all puts, though. The D's 2019 par calls doing nearly 10,000 this week if you are on the bullish side of the fence. Also worth noting here, we did the 75 calls here. These are in D's doing 13,000. A lot of that today, actually, 5,500 going up today. So it's not all puts, Mr. Nick, but it's a lot of puts. There's been this talk for a while now, this continued increase in all things crude. We saw, the tweeter-in-chief tweeting about OPEC last week and saying prices are on the move because of them, even though a lot of it driven by sanctions as well. So there's a lot of back and forth in crude land. A lot of people are paying attention. Mr. Nick, what's been catching your eye in the crude land this week, sir?
Yeah, well, I like I said last week, and again, I consider myself casual observer. I'm like I said, I'm in a chat group with some professional WTI guys, and they obviously are trading more of intraday stuff and not so much long-term perspective. But just I tend to look at it just from what the numbers are saying and what that indicates for going forward. But we're up this week, as is obvious, but not much going on with the vol. But I think part of that reason we're not seeing a big increase in the vol is, like we talk about, if we move a strike or two, we're kind of sliding down the body of the vol curve. So the reality is the vol. Well, no, I'm lying that way. Since we're sliding down the body of the vol curve, and we would expect the vol to go up, we're getting a little bit of bump up. So we are up probably more than we even say in this volatility, because our curve is sloped where the calls are offered and the puts are bid. So we're going to start going down the slide from left to right. And the fact that vol's up means that we're going to get a little bit of a bump up in actual movement of that curve. So we do see a little bit of a push up in vol, and it's not just based on the movement or the local volatility around the strike. The puts aren't quite as bid as they were last week, a little bit offered there, and the calls are offered more than they were last week. So you get a little bit cheaper puts, but you get also cheaper calls. So that's probably just more of a wrenching of the curve. So we tilt the curve up. It's just sort of pulled down, but pulled down a little bit more on the right-hand side. So that's really how I try to pay attention to the markets where obviously I'm not trading them, but you look and see what's happening with the skew. You start to see some of the expectation from the way the curve is shaped. But some of the things that seem a little strange with the calls being offered, you're getting a lot of these high stock calls that are trading. You mentioned the D19. Almost 10,000 of the 100 strike traded, but you're seeing a big offering there on strikes that are that far out from a delta standpoint. So I think, and the other thing I noticed, and again, for as much as I noticed and paying attention, there was talk about seeing expectation of crude going to 100, and then you see Goldman dampens expectation of crude going for 100. So that's why when everybody's gonna. That's why I kind of look at what the curve's doing. It looks like puts are bid, calls are offered, probably have a limited upside just based on what the vol curve looks like. You got to look at it to some extent, with people having some expectation that we move down a little bit, how far down that is. But I still think, like I said last week, for us to sort of cycle between 65 and 75, it's a big range, a fairly big range. I'd even say we'd cycle between 68 and 73 or 74. So as much as there's been some movement on the upside today, I don't think there's much going on in terms of expectation, at least until there's another number coming out with the EIA and stuff like that.
Where there are things going on, Mr. Nick, is where a lot of our listeners love when we talk about equities. We'll get into equities. Our buddy Sean can't be here this week. He's off in New York, so we'll do able business in his stead over here. Unfortunately, he couldn't bring his delicious burgers to the studio this week, so we miss him even more. Even more for that, Nick. You got to come in for the burgers one of these days. It was delicious. And it kind of just fires you up. All that nice red meat gives you just fired up for the show, sir. And then you fall asleep afterwards. It's perfect.
I was saying I'd be sleeping, that's for sure.
But you fall asleep after the show. It gives you a nice hour of energy, and then you collapse. But it's good. You need it. So, we like to talk about the vol spread out there. And the vol spread actually is widening out right now. Our old friend VIX hovering around a 12 handle right now, which is, of course, the S&P volatility. Our old friend RVX, which is the Russell 2000 volatility, close to a 15, about a 14.9. So right about a 2.9 handle spread. That's about 3/4 of a point wider than it was this time last week. A lot of that coming from just kind of the volatility of VIX out there right now, which is has been moving quite a bit of late. As it rallied well north of the 12 handle, then dropping right back down again out there this week. So that driving a lot of it. Coming in again today, the volatility of VIX right around an 87. So not quite as high as it has been of late, but still it was rocking and rolling earlier here this week. But Mr. Nick, one of the reasons I want to get to equities is because we need your help solving a question here. We like to ask questions to our audience, and this week's one's a fun one, partly because it gives us an excuse to do a deep dive into the QuikStrike tool. So are you ready, sir? Are you ready to lend us a hand with your able analysis?
I will do my best.
All right, here we go. Our question of the week this week is, a lot of people were talking last week about S&P Skew getting crazy. People were tweeting out about the Skew index over 150, there's alarm, all this kind of stuff. But we know every index kind of has this little bit of its own kind of skew story, a little bit of its own skew slope. So we thought we'll ask you guys, the audience out there, which index do you think right now has the steepest skew? Of course, we're talking about the 25 delta put versus the old 25 delta call. So that 50 delta risk averse, that's what we're comparing. We talk about steep, we talk about richness of the puts to the cheapness of the calls. That's the typical index, aka the investment skew. If it goes the other way, something crazy is happening. So it's going to be that way. We gave you the three usual choices: our old friend, the Russell 2000, the S&P 500, or the Nasdaq. You can pick your poison on which ones you want to look at. We're looking at QuikStrike here, so we're going to look at the ones here on the S&P. Mr. Nick, before we even get started, do you have a guess of your own?
Well, I would have guessed just historically that it would be the ES S&P E-mini, but I think I'm going to be mistaken looking at the numbers here, because what I would do to answer that question is I would go to QuikStrike's QuikVol tool and look at the QuikSkew measurement. That would give me the width or the separation between the 25 delta put and the 25 delta call in comparison to the at the money, and it looks like we might have a new winner. What do you think? Did you look? Do you know?
I haven't looked yet. I've been I've been saving it for this show. I was looking forward to doing the analysis here on the show, but you got to beat me to it. That's great. So you're a lot faster at the tools than I am here. So since you have the numbers in front of you, we'll do a little spoilers for our listeners. If they listen in live, they get to hear the answer. What's your analysis telling you, sir?
Well, I'm gonna while I'm clicking to get to something, I'll beat around the bush for a second. I will push out a report that has all of the skews for the benchmark products, and then people could take a look at that and see what they think. It's actually looks like from an across the board standpoint. I'm trying to look. I got to make sure I get like expirations here.
That's the challenge: is lining up like with like.
Yeah, well, let's see, 36. I really want to be careful here. Let me see, NASDAQ. That's like the 50-day option is 17. Let's take a look at that one.
Tell you what, while you do that, I can break down some options activity out here. I'll buy you some time while you're doing the analysis. Also using the old QuikStrike tools. Let's go to our old friend, the E-mini S&P, see what's lighting it up out here this week on CME Group here while Nick is doing the heavy lifting here. And again, if you're talking equity indexes, you're probably talking the weeklies, and that's kind of what's lighting it up out here this week. Coming into the show, we're at about 29.25 in the E-mini, off about 10 handles here. We're seeing the 29.5 calls actually lighting it up, which is kind of interesting, taking the number one spot here with 22,000, about 300 contracts lighting it up. Obviously, you guys know the vol story out here. Vol has come off a little bit out here in terms of net, but on the week we're actually up a little bit on vol here. So interesting stuff out here in the E-minis. 22, almost 23,000 of the 29.5 calls. pretty much back and forth. The OI is slightly down a little bit on the week, but the lion's share coming up yesterday, 11,600 going up. Then the rest kind of scattered throughout the week. That's the biggest print. I'm just trying to see if there's anything else out here that comes close to that. Then we got next are the 2940 calls, about 14,400 again out there in that front week contract with 1 day to go. So the weeklies are still where the predominance of the action is. That's a little bit opening, about 2,300. So maybe a little bit of verticals, maybe there's some upside action. That's kind of interesting, a little bit surprising, but it's also in line with our question of the week from last week where we asked you where the biggest open position was in SPY right now. And it actually was the end of the year, December 31st, 320 call, I believe. So upside is still where a lot of the action is here in the S&P, and it still is today. Mr. Nick, did I buy you enough time, sir? Is that enough vamping for you?
Yeah, I just wanted to double check something. So a couple ways to look at this. So typically when we talk about QuikSkew, we're talking about the 30-day constant maturity. So, and in the indexes, there's generally enough expirations. There's enough weekly Wednesdays and Fridays and all that kind of stuff that we're going to really be spot on when it comes to getting something by using that constant maturity value. So as I initially said, and then I backtracked a little bit, the NASDAQ actually has on the 30-day constant maturity, which there's something within 1 or 2 days right now within that expiration time frame in obviously both of the indexes. The puts are 20% more expensive. So if they're trading 10, the money is trading 10, the puts would be trading 12. And the calls are 13 or 14% cheap. So they'd be trading eight or 9. So the slope, the gap between the call and the put, the 25 delta call and put, is widest in the NASDAQ 100. Now that's around the 30 and 40 day. When we start to get out a little bit further, the NASDAQ has a little bit steeper. The S&P is a little bit more steep when we go outside of there. But in the near term, where a lot of the activity is going, the NASDAQ definitely has the wider channel at this point, meaning in both respects, the puts are more expensive and the calls are cheaper. And given the ranges, as you probably can attest to better than I, Mark, the ranges in the NASDAQ have been much more significant from a movement standpoint,
yes,
and a percentage standpoint. So that makes a lot of sense based on what the market's doing. But yeah, typically we've seen, we haven't seen the S&P get, surpassed like that from the investment skew. But, just eyeballing the S&P 30-day, it just, like right now I have on this report, and again, I'll tweet it out right now. The puts are the cheapest they've been when we go back and look across a 1 week, 1 month, 2 month, 3 month, 6 month, 9 month, 12 month. We do the averages across all those periods of time. The puts are the cheapest they've been in the last year, and the calls are the most expensive at 11% cheap to the money. So this will be a good one to get out there so people could take a look at it. And this has all the asset classes, so you'll be able to compare and contrast for yourself. So that in and of itself, the fact that both of our numbers are colored, meaning one's red and one's green, one for being cheap, one for being green, that's the tightest we've seen it in a long time. So here we're going to see, we're going to tweet out, this is called the 30-day benchmark QuikSkew. Okay. So you can get that out on Twitter, and I will get at options on there and at CME Group. So that's probably something to pay attention. We could go back. We can mention Sean, even though he's not here. Buy puts while you can, not when you need them. Right? Is that what it is?
That's pretty much it. Yeah, have them when you can, when you need it, when you want, when you can. Yeah, not when you need to. We've seen a lot of examples of that.
So right now they're the cheapest they've been on average in a year. So that's saying something.
It is. That's one of the reasons why I wanted to do this analysis on this show. I know you love the equities, Mr. Nick, but this is the place to do it because we actually have the tools available. I was kind of saving it here. Now that was my one question I had in the back of my head. I had what I thought the answer was, but NASDAQ has been the wild card of late, and I was kind of wondering if NASDAQ had kind of edged it out just because it's been more volatile of late. And of course, we're talking, when when you're doing this analysis, you got to kind of talk in the front, front contracts, the front weeks and front month. You can't really go much beyond that. So it doesn't surprise me that the S&P would be more steep longer term, because that's where a lot of the big size institutional hedging is going on, right? So they're bidding up the longer term portion of the skew. But in the near term, NASDAQ's been moving all over the place. So it doesn't surprise me that NASDAQ, I didn't want to give out my answer until after we had the analysis, but I was kind of leaning, just for the wild card sake, I was kind of leaning the NASDAQ direction. That's why I like having the actual QuikSkew numbers. Follow Mr. Nick over there at QuikStrike1, QuikStrike1, no C. So he tweets it out. We'll also reshare it for all of you guys out there too, and retweet it so you guys can see it and see where to go. But this is cool stuff, and this is the reason why. This is why we like to do the show, Nick. Quite frankly, this is the kind of data that we could talk about that you can't really find anywhere else, and you could compare for yourself. People are hitting us up all the time about skew questions, Nick. Skew this, skew that, skew on the index. Here's actual data you guys can use in your own trading. So check it out. Speaking of you guys, I don't know, Mr. Nick, I'll leave it up to you. You want to do metals, or do you want to dive into questions? What do you want to do?
Well, let's just talk quickly about metals, only because it's just getting the crap beat out of it, right? I mean, I think this is where we usually like to talk about it. We are. Let's go to gold. Let's do it. I think we should. We are near our lows. Vol is cheap, near our lows in a long time, and near our lows in the range for a period of time. So this is like, I think last week when I said I don't even like that covered put strategy or the hedge put. I think now, being that we're down $12 on the week, $12-13, and Vol's offered, and we're at the bottom of a range, and the puts got a little bit of a bid to them in comparison to last week, but they're pretty flat to that. The money now seems like a good time to do that, to get in there, buy some puts, buy some futures. If we continue to slide south, I mean, I would imagine if we start dipping into the 70s, that we get a little bit of a bid in the volatility. Now, strong dollar is going to be weaker gold. At least that's how it's been lately. But I'm just reading all these. I just saw a bunch of these headlines how foreign countries were buying most gold that they bought. I forget what specifically it said. There was buying gold at record pace, and then when I saw that headline, I expected to see a little bit of a pop, but this is an offer here, and I think this is the level that I tend to think that if we keep going, Vol's going to get bid, and if we move back up, you can make your money back on a put covered with deltas. You
love your puts and futures.
I do. That's your go-to. I love cheap options hedged at extreme parts of the range, because I feel like if you get options and you understand gamma and you're diligent about stuff, I think there's real opportunity. I like putting on bets where a part of your trade, in this case the futures, you can get your money back and the other sits for free, basically.
Are you talking, 1-to-1? Are you talking like delta neutral? How do you like to do it?
No, I'm talking delta neutral on this. If you go out there and look, I mean, we can also build that trade and tweet that out. I'm talking about looking at I like looking at like the 25 delta put, whatever that ends up being, and then covering that with futures. And here, we got a minute. Let's give me 1 minute, and we can do this live, and we can talk about it a little bit. And I'll do the let's do the DEES contract for this, and I will build this out, and I could see where's my delta here. So we'll do the 1160 strike is the 25 delta. That's like 7 ticks right now, and I'm in DEES, and that's like a 60-day option. So that might even be a little bit rich. So let me go back out and go to the November contract. That might give us a better one. And I know that I'm kind of yammering a little bit, but the 60-day is just a little expensive. I don't think it's worth it so much. So now if we go to the November, and we are right at, what do we got? We can pick, we'll do the 1170, right? So we're basically $17 away from that. That costs five ticks. And if I hedge that right now it's a 26 delta, so I'll hedge it with a 26 delta. Your break even becomes with your futures right now here at 1188. Your break even becomes 1207.70, so 1208. So we were just up there the other day, right? So
yeah, that's my
point. It's not far at all, and we were just there. And we're off 12 today, but we were we traded 1208 either yesterday or the day before. So that's what I mean. When you can hedge and get your money back just on sort of this nothing range and nothing burger range that we've had over the last couple of days, to me those seem like and your break even on the downside is 1156. You get eaten alive if you go down to 1170. But if you start to go down to 1170, you're going to get bid. You still got 30 days. So there's a lot of goodness to that trade, So anyway, I just wanted to talk about it just for that reason.
The goodness, there's a lot of goodness in that trade. That's a new term. The goodness of gold. And you're right. You can't really. It's hard to advocate any sort of premium harvesting in gold options right now. The vol's been anemic forever, right? I mean, this is so you're not getting a lot of juice out there. So if you want to lean somewhere, you got to lean long premium, and doing a little bit of futures hedge in your back pocket helps you. On some of these days when you need a little bit of extra kick to get that trade going. So yeah, it's hard to argue against that one. It's also hard to argue with you guys because you guys got all sides of crazy ideas and questions. Let's get to them with a little bit of your futures options feedback.
It's time for your questions, comments, and insights. It's time for Futures Options Feedback. Submit your questions at twitter.com/options. Facebook.com/The Options Insider, StockTwits.com/Options Insider, or via questions at theoptionsinsider.com. You can also submit your feedback via our Options Insider Radio Network mobile app, available for iOS, Android, and Kindle Fire devices. You can even ask your questions live every Friday at 3 p.m. Central via our Mixlr chat room. So grab the Mixlr app or just search for Options Insider at Mixlr.com. That's MIXLR.com.
All right, everybody, let's do it. Let's join the party here on QuikVol with your questions, your comments. You got a lot of them. Let's get to them. I'm just going to go in order here because we got a lot. We already did. The guy here wants to know about Nick back in his post-mullet days on the Euro pits. What do we got here? John C. David chiming in about trade wars, loss of farmers, tax cuts, failed policies. A lot of looks like it's a big screed about the current tax cut policies and how it's hurting farmers. Interesting stuff here, John. If maybe not for the show. We don't really go too political on here. Let's go. Here's an interesting one from EggsOver. I like my eggs over easy. Maybe you like them differently. I don't know. EggsOver wants to know, what's the biggest derivatives market outside the U.S.? All right, there's a lot of ways we could answer this particular. I'm going to cheat and look at the data actually provided by our friends over there at FIA, the Futures Industry Association. They study these things. They analyze global derivatives volume. Obviously, and so there's a couple of ways to answer it. By region, because that's a market, the U.S. versus other things, or even by individual markets like exchanges. Either way, the number one is here. And number one exchange is obviously CME, and number one region is obviously the U.S. So those two. So he wants to know the number two. Number two by region is going to be Asia. In fact, here, according to FIA here, North America actually exhibited the largest volume. We saw an increase here of nearly 20%. Asia Pacific, as they term the region, is the second largest derivatives region, had the greatest growth in absolute terms, more than 5.12 billion contracts traded on Asian exchanges. That's up over 1 billion or 25%. From last year. So Asia is the biggest region. In terms of biggest exchange after CME, I know Brazil's B3 is number 3. That just surpassed ICE this in the first half of this year. I'll have to look down to see what number 2 is and do a little digging. I don't know. Mr. Nick, do you have any insight into the number 2 global exchange here while I'm doing some digging? I know number 3 is in Brazil. I don't know number 2.
I don't, but I will comment on the Brazil thing. I talked to one of my friends at the CME, and they're big on, they do a lot of presentations down in Brazil, and they said the volume in Brazil has increased just almost exponentially, given that they introduced like a micro version. They've been introducing like smaller than mini version contracts. And they've obviously, the volume increases, it's times the notional that they're looking at, but the volume increase has really been tremendous with these smaller contracts. So they're getting more and more people down there to trade, which probably means more retail are trading bigger size, or institutional are trading more of the smaller size contract. But if it's by volume, I would imagine that if Brazil, the intent there is to also introduce other asset class products that have that same sort of smaller version of the contract, that if it starts to be by volume and not notional, you'll see Brazil push up pretty quick.
Here we go. I got the numbers now. I had to actually download a spreadsheet to get the answers, Mr. Nick. Are you ready? You want to hazard a guess?
That it's
number 1 is CME by a long distance. Number 3 is B3. What do you think slots in at number 2? It's not ICE. I'll give you that.
Exchange?
Yes. Global derivatives volume. So all across the board.
Global derivatives volume.
Now, obviously, volume is a misleading thing because you can have some small contracts doing a lot of numbers, but we're just talking volume. I'll give you the answer because it's a hard one. It's the NSE, National Stock Exchange of India.
Really?
CME doing about 2.5 looks like billion contracts here, Jan through June of 2018. 1.6 billion for the National Stock Exchange of India, 1.3 for B3, and 1.26 for ICE. So interesting. Interesting.
That's futures and options.
Yeah, that's global derivatives volume. So ICE adds FIA adds them both together.
I bet you ICE's is 80% futures and 20%
yeah, they
options.
don't. They still don't have. They obviously own NYSE and they have an Amex, so they have some skin in the options game there. But yeah, they've never been big. Sprecher has said himself many times he's not that interested in the options market. So number 2 is an interesting question here. EggsOver, not one. See, that's why I like the listeners, Nick. They take us in weird places that I would never have thought to go. That's why we like you guys. Next up, this is right up your alley, Mr. Nick. He should probably just send this to you. This is a question from Charlie Cott. He wants to know, is QuikVol, I think he means the same as QuikSkew or something else? And are they all available in QuikStrike? So he's got, I guess, a little bit of brand confusion here, Mr. Nick. Set him straight. What is QuikSkew versus QuikVol versus QuikStrike?
Okay, well that's actually good. If people need clarity, then maybe I need to think some things. But so QuikStrike is the suite of products. Okay, so QuikStrike has all the tools for pricing and analysis. QuikVol is just a section of QuikStrike. Okay, so that's volatility information, historical volatility information, and that is available obviously within the same QuikStrike tool. So QuikVol is a part of QuikStrike. It just happens to be, I tried to name these QuikStrike options, right? There's strike, it's options, or QuikVol, it's volatility oriented. Obviously, there's strikes there, but you're looking more at volatility analysis type things. And then QuikSkew is within QuikVol. So QuikSkew is just a measure within, since Skew is a particular of volatility, QuikSkew is just a measure within the volatility tools of QuikVol. So that's really, QuikStrike is the main product. Everything that we offer is always going to be under the umbrella of QuikStrike, and QuikVol is available as part of any level of QuikStrike. So whether you're using the paid subscription versions, there's a rolling year worth of information there in the professional edition. In the free version of QuikStrike Essentials, there is a 30-day window that you can see. But as part of that tool, you can also purchase ad hoc volatility data directly from the chart or going through a wizard. So if you're looking for 1 year of e-mini data, you can do that. It costs you $25, I think, something like that. And then there's also a part of QuikVol or a limited subset of QuikVol available as part of the CME Direct integration with QuikStrike as well. So QuikStrike's the big thing. QuikVol is sort of a section of QuikStrike, and QuikSkew is a way we measure skew. So that's how you think of, when I talk about QuikSkew, it's just a measurement. It's a way of looking at volatility, a way of looking at the volatility curve with a set of numbers that will tell you what the shape of the curve looks like and what it looks like historically in terms of flipping back and forth, or like we just talked about in the last question, the width between the 20. In the case that we talk about the 25 delta, but we have QuikSkew measurements for the 10 delta, the 5 delta, the 30 delta, the 20 delta, all that kind of stuff.
All right. Hope that clears you up, Charlie. Sure, it clears up your confusion. Nick, this next one here is actually kind of Kind of related to what we were talking about a little bit earlier in the show. This comes from Tamavil. That sounds like a drug company or a pharmaceutical. Tamavil.
The Tamiflu.
Yeah, exactly. It sounds like something like that. Tamavil wants to know, does it make sense for an active trader to become a member of the exchanges anymore? Or are those days gone? I touched on this a little bit earlier in the week on my network, but it's an interesting question. We were just talking about, your days in the Eurodollar, my days in the SPX, and then in the equity options over on the SIBO. I think the best way to gauge this, Nick, because you can't really look at seat prices anymore. Seat prices have completely disassociated from the trading interest. They're an investment vehicle. People will buy them, and then of course they became shares, and the whole thing has become different. It's a different deal now. So the actual trading interest is still going to be looking at in the leases, right? That's where people actually would go and lease, and those are back. I don't know what yours were, Nick, when you're in the Eurodollars. I was paying somewhere between $15,000 and $20,000 a month to get into the SIBO, and it was like a 3-month waiting period for the privilege of doing that. And this was an entity that if people had bought it in the 70s, early 80s, probably cost like $20,000, So they were leasing for more than their initial sale value. That's how ridiculous and rich it was to be down on the trading floor in the midst. This is the go-go 90s into the early 2000s when things were really just rocking and rolling. Transition to the modern period. The exchanges are now for profit. The seats have become shares. So the lease is a little bit different. And you can see now you can go to any exchange you want right now and kind of lease seats or get the trading privileges, quote unquote, for not much, So the interest in that has very much waned, and you can see it. A lot of the trading floors have dwindled. Not people standing down there for kind of the reasons that Nick and I alluded to earlier. So all that a back way around to I don't these days. There's not really a lot of reason that I could see to really want to go back and stand in a crowd, because what you got for that, you got a lot of things. You got access to flow. That's not really down there anymore. You used to be the first guy to see this stuff. No, the stuff's all shopped now. Time it gets down to you, you're the last guy to see it. There's not a lot of good flow to be there. A lot of it is internalized and crossed. So there's a lot of reasons why paying money to stand down there doesn't really make a heck of a lot of sense. On top of that, the markets are much tighter now. The spread to make money in between them, to be on the bid and the offer, it's one of the reasons you were paying to be down there. Not much incentive as for that as well. Mr. Nick, would you concur, or maybe you think it's the time to dive in?
Well, I mean, one thing I don't think you dropped on was there's got to be some benefit being an exchange member from a fee standpoint, right? So the costs per car per execution, I think there's some benefit there because you do get a break. But I don't know the financials behind that. But there's so many platforms now. I don't know that and like you said at the end, you used to be down there for the edge to hear what's going on first, but now the liquidity is so great on the electronic platforms. Put it this way, I don't think the exchange there I know people who trade upstairs that are members, right? So a member will get you fee reduction. So I think there's the benefit. The fee reduction is going to benefit you if you're doing enough volume. But if you're a retail person and your volume is going to be limited, or you're doing some just more long-term stuff, I don't necessarily know how much it's worth. And also, like you said, I think they're working to get rid of the whole shareholder access via the seat anyway. I think that ship has sailed as well. So
yeah, all that stuff's
fine not doing anything.
Yeah, so for the focus of his question, which sounds like an active retail trader, doesn't make any sense. The retail platforms are so good now; they're much better than they used to be. The cost of execution for retail is so low. Well, like Nick said, unless you're doing so many contracts that it makes sense somehow on a fee basis, that's a very small percentage of people. I can think I can count on one hand the number of people I know who've transitioned from the active retail onto actual trading on the floor type of scenario. So it's a very rare thing. So yeah, the short answer is going to be no, outside of a few very rare scenario. Mr. Nick, I'll let you pick. We got time for one more. I'll let you pick the last one you want to dive into. What's floating your boat here? We got a bunch of different weird stuff here. What's catching your eye?
Let's answer the simple one from Musaeus.
Okay, Musaeus. I'm glad you pronounced that. Musaeus. All right, Musaeus wants to know if I buy a call option and afterwards sell it for a profit. You can tell he's probably, not just the name, but the way he writes that is like it. Probably not English, not his first language, but I like it. I like the way he's going for it. And afterwards sell it for a profit. It just sounds more formal that way. Let me start this over. If I buy a call option and afterwards sell it for a profit, first off, well done. He goes on to write, I'm not the one obligated to sell 100 shares if that option is exercised later, right? How do I close my call option position completely and take my profit or loss? You hit on it, Musaeus. You outlined it right there. You buy a call, it goes your favor, you sell it out for a profit. You did it. Rinse and repeat. Make your money. Be happy. Yes, if you buy it and sell it out, you have closed your position. You are not obligated for anything. You are not the person who now in turn buys it. On the other hand, they're the one. They're the one who has the option to exercise it, and the person who sells it to them is going to be the one who's on the hook to not you. Don't worry. So yeah, that's how you close your position. You do the other side of it. So if you buy it, option, same month, same strike, same contract, then you turn around and sell it, same month, same strike, you have closed your position. Well done. Take your money and be happy. Mr. Nick, anything you want to add here for, I just like that name, Musaeus. I like that.
Because you think you're in Lion King.
Mufasa, that's what you're thinking of.
Right, that's right, I know.
Mufasa, I like that.
That's what I was thinking.
Mufasa can
That's
write
how
it
I knew how to sort of say it. But no, I wanted us to answer that one just because I think that's a pretty key thing to understand if you're going to trade options. Like, you buy it, you sell it, you're out. There's no more obligation for you. That's the obligation is on who is part of the open interest number. There's one buyer and one seller. That's one unit of open interest. So as long as you're on one of those legs, you have a responsibility one way or another. If you're on the long side of a call, you're going to have to buy. And if you're on the short side of the call, well, if you're on the long side of the buy, you have the right to purchase. You don't have to. But if you're on the short side, you have the obligation to deliver, right? So once you get in and out, you're done. But if you hold it or you're the seller of it, the holder has the option and the seller has the obligation. So there's a big thing.
I don't know, Mr. Nick, I'm feeling charitable. Should we do like one more?
Sure.
You want to? All right, let's go. Since you mentioned OI, we'll stay on the OI theme here with J.L. Smith. They say, how important is OI when you're trading options? Are there other indicators that you focus on instead? We talked on this before. OI, obviously open interest. Nick just alluded to it when he was answering it there with the well-named Musaeus. OI, of course, open interest, it shows what's outstanding on the actual strike. It's important, but it's not. People always key on it first. It's not where I go first. Usually OI could be reflective of a lot of things. It could be reflective of one size trade that's just parked there, and it's not reflective of actual day-to-day volume. If you have a lot of actual volume, if that strike in that month are actually liquid, that will be reflected in the spread, and that's, I think, a more important indicator. You can go to a ton of strikes out there right now that have a ton of open interest, and the spreads are also super wide because nobody trades it. It's a one-off trade. If they're super active, they can have a lot of open interest because it churns every day, but the spread is tight. So that's an indicator that I focus on more. First off, I look at the spread because the spread is going to tell you a lot of what you need to know. It's going to tell you if it's liquid and all the other things, when you can get in and get out. OI can sometimes be misleading. You look at a lot of OI and say, oh, this is a really hot strike, and then you look at it and it prints once and it's that one trade, and then the rest of it it's 50 cents wide or whatever on the rest of the time. So OI can be a little bit misleading. It's important, particularly if you're looking at what we do a lot of, which is unusual activity analysis. You need to know what the other side may have been. So that's where OI really comes in handy. You could tell, oh, this trade's probably closing. So that gives you a little bit of a different bent than if you're analyzing an opening trade. So that's where it's most valuable. And also looking at a name where you're going to trade for the first time, you want to see what the big positions are out there. So OI will tell you that, so they can give you some idea what may be active, what may be trading in the future, what people have traded in the past. OI gives you a good snapshot of that. But outside of that, I don't use it for a lot. Mr. Nick, you guys are kind of the keepers of OI over there at QuikStrike. What do you have to say here for J.L. Smith? How important is OI to you, sir?
Well, I have a couple ways to answer that. So first of all, you have to. The magnitude is important, like especially in the products that are like the commodity-based products, because what happens is you don't get a lot of activity trading. You don't get as much activity trading, and still it starts to become part of the active contract in the market. Now that's partially true in that you'll see a wider swath, like in WTI, you'll see trade and you'll see the strikes build up, but it's almost important to look at it from an aged OI standpoint. So we have a report that's almost done where we age the OI. So you'll be able to say what's the OI in the last 30 days. And it's not necessarily just a change, but the new open interest. So you'll be able to see. So I remember we talked about a while ago, we had some massive open interest in some gold probably last year, but that trade took place 6 or 8 months prior by something stupid, and then the market moved, but it was still always being the leading open interest. So you have to look at it from an age standpoint. We'll be giving you that ability shortly, sometime next quarter. The other thing, OI is important. I like talking about it. Mark likes talking about it when we're looking at sort of range bound stuff, and it's relevant in like this commodity stuff because the OI starts to pick up when we start to trade around or move inside or outside of a range or around a range. Then you start to see those borders. The other reason it's important because a lot of people will do in certain markets, and it happened in the Eurodollars quite a bit. I don't know if it happened in the Treasury so much when I was down there, but in the Eurodollars we used to do boxes. So we'd buy a call spread, sell a call spread, buy a call spread, sell a put spread in a couple strikes. And we'd do a deep in, or we'd buy a deep in call spread, and with really massive open interest, and then you'd exercise your stuff right away, and then you let the short strike. You would see if you got assigned on that short strike, and the hope was that you didn't get assigned on all of them because it would be a round robin assignment. So what you would do is then you'd be lending money at a particular interest rate, and that's when the rates were not zero. But you would do this big box exercise. You pay a bunch of premium for the one, exercise it right away, so it just turned right into a future, and you'd hope your short premium would be able to sit in your account for a while and gain interest. So there was a lot of that went on too, especially when we had a big move in one direction or another. We would do these deep in spreads or boxes and then do an exercise and then hope that that a premium would sit in our account for a while and gain some interest. So it's important I like to look at it from looking at a range standpoint where the activity is, also seeing how deep the liquidity is, as Mark said, in a particular contract and or product in general. And then also for interest rate plays like we used to do when we try to get premium with money sitting in our account. And it's starting to get better now because you can get, when these short-term rates start to go up, that's what most of the brokerage accounts are getting is short-term rates. So you might be able to get a couple percent sitting in there, $100,000 for a while, if the ball, bounces the way you want in terms of an assignment standpoint.
Boxes, the good old days of boxes. You used to put those up in the S&P all the time too. Don't see them as much anymore. They're not that margin friendly, and some of the fees associated with boxes. I talked to a few market making firms who said they won't even quote them anymore because the capital requirements and everything else are so onerous on boxes now, and the fees that it's cost prohibitive. You can't do a box anymore. So yeah, the good old days are kind of dwindling, Nick. No more box love. But yeah, that's a good point about the ages of OI, because that's something we do a lot. I didn't even know you were working on that report. That's really cool, because that's the first thing we do whenever we see size OI, right? Is we go back and dig and see when was it open, right? That's the first thing you do. So do you have, when that aged OI report comes out, let me know, because I'll be very intrigued by that. Since we're talking about reports you guys have coming, what else is cooking, sir, in the land of all things QuikStrike? First off, when am I getting that aged OI report? That sounds pretty cool.
Age OI, we're working on some tools, and hopefully that'll be it'll be in the next quarter sometime. So it's just a matter of kind of getting it filtered up the list a little bit as we work on some other stuff. What else is happening? There'll be some new tools coming out via the CME Group website. They're already in portions of regular QuikStrike, but the free versions will be coming out. We'll be getting you an event calendar, which will be coming soon, which you'll be able to see all of the numbers across all of the different countries, and tied to those number days, you'll be able to see what expirations are what expirations are available for you to trade those given numbers. So that's coming. That's going to be the event calculator, and then the event calendar, and then there's another event volatility calculator coming out very soon, and then a few other things which I can't necessarily talk about that will be related to some of the new products that are going to soon be available on the CME to trade. I'll just say there are new interest rate products that everybody should know about already, but I can't talk about the tools associated with them just quite yet.
Secret upcoming stuff. Mr. Nick, if people want to stay on top of the latest secret stuff from you guys, or maybe they want to sign up for what you guys already have, where should they go? What should they do?
So the easiest thing, there's a couple different versions. You can go to bantix.com and say register for a trial, and there you'll get access to the professional edition subscription. And then you can go to cmegroup.com/QuikStrike, where you'll have access to all the tools available there. You can either use them as one-offs, or you can register for QuikStrike Essentials, which will aggregate those into a nice package. And then if you are trading, if you have a trading platform or you're looking for a trading platform, you can register for CME Direct, and there is a version of QuikStrike that's embedded as part of there. And the other thing to keep in mind, in all those versions I mentioned, the QuikVol tool is available, where you can get all your historical volatility needs, including the measurement QuikSkew that's available as part of the QuikVol suite of analysis. And you can get some free looks at the history, and you could also purchase ad hoc downloads of anything from 30-day volatility, actual expiration volatility, to realized futures volatility, as well as futures high, low, open, close, and open interest and volume numbers as well. So there's a lot out there. If you're looking to do some analysis, or you have some projects to do, or you just need data in-house, you can get it by asset class, or the entirety of the 42 benchmarks that we offer as part of that service.
There you go. Check it out, listeners. I'll also put a link in the live chat there, so you guys who listen in live now can check it out for yourself. A lot of places to do it. Bantix.com, probably the easiest place to kick the tires and light the fires, as they say. And don't forget our friends over there at FTSE Russell. Give them a follow at FTSE Russell on Twitter, or of course go to FTSERussell.com. A lot of great data, benchmarking, active versus passive, all this equity skew stuff we're talking about. They have some of that stuff as well, equity volatility, a lot of that kind of stuff. You guys certainly got your fill of volatility and skew today, particularly those of you who tuned in for VolViews and TWIFO. You got a double dose of it, so hope you're happy. Stop sending me your angry emails. We got it on both shows. And of course, our friends over there at CME Group as well. You can go to cmegroup.com/TWIFO, check out the reports there as well, and sign up for a trial of the QuikStrike Essentials, because that's the, frankly, we said it before, if you're trading these products and you're not using those, I don't know how you're doing it. You must be using an abacus and a calculator, because it's kind of the only game in town. So cmegroup.com/TWIFO, another place to go to get that stuff. And on behalf of Mr. Nick and our friends at FTSE, and indeed at CME, and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, sending in such great questions. We love them. All of you who tuned in for this show and both shows, we love you all, especially the hardcores out there. Your stamina is impressive. And I'll see you next time for more of This Week in Futures Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.